the macro backdrop is always key, but I think probably more so going into 2021. So by that I mean interest rates. So interest rates are at incredibly, historically low levels. Central banks globally have confirmed that they want to keep interest rates at low levels. The RBA here in Australia has said that they're going to peg the 3-year bond yield to 10 basis points. So you think about the backdrop for equities in that scenario. They love low interest rates, so that's a really positive thing for the equity market. On the fiscal side, so how governments are going to support the recovery coming out of COVID, I think is going to be key. So the big focus is it's what's happening in the US on the fiscal side. We're expecting a pretty large package to come out of the US, and I think that's going to be supportive of the market going forward. And then in terms of the vaccine rollout, so we've often we've had really strong data out of the trials from the vaccine. We've got the UK starting to roll theirs out. It often it makes me nervous in terms of if I liken it to developing a mine. We've gone out there and there's been a lot of exploration done, and we've had really good exploration success. But a lot of complexity can come when you've got to develop the mine and roll the mine out and meet those production targets and all of that. So I think that's really going to be key in 2021 as well, how well we roll out the vaccine on a global context. If you think more micro, so in terms of stocks, it's really thinking about what the influences of COVID have been, whether they're transient influences or more structural influences in nature. So I think about something like travel stocks are probably the most obvious ones. Have the influences of COVID been structural or transient? So I think structurally, corporates are going to travel less. So that's going to have a really big impact on the travel spend from corporates. So that has a big bearing on the travel stocks as a group here in Australia and globally. If you think about that in the context of supermarkets, we've all shopped more online. So that's been the tipping point, I think, for supermarkets to be able to get scale in their online offering, which I think is a real positive and a structural tailwind for that area of the market. So, those sort of things we're thinking about from a micro side. There's always a lot of things in the market that we should be careful of, but it's easy, I think, to get overconfident after, we've had the best month in November in 32 years. I think we've had a lot of new people come into the market, opening new investor accounts. We've seen a big uptick in the number of subscriptions we've been selling in Market Matters. So to me, I think it's probably that that complacency you can get if you go into the market rallies. The market's up 40%. Stocks are up 50, 100% in some cases. So that concern that I have that people think it's all too easy. It's hard in the market to consistently deliver results. So delivering consistently is a really important key for investors out there. So that probably would be my the areas that I think you should be careful of going into 21, and of course being in the right sectors at the right time. So the backdrop that I've just talked about, the macro backdrop, is starting to feed into higher inflationary expectations. So from a portfolio positioning point of view, you need to be conscious of that. So there's areas in the market that really benefit as longer term interest rates rise, inflationary expectations rise, and the like. When I look at a company, I want a company to be not being influenced by the external factors happening in the market in terms of the market noise. So I want management to be running their companies as they, in the best they can, given the conditions they're operating in. It's been, 2020 has been a lot of uncertainty around that, and those companies that have really dug in and run their business as best they possibly can have come through COVID in a pretty good shape, I think. So we've got positions in the portfolio in Costa Group, which is, I think, managed that period during COVID extremely well, and the business has now got some real strong tailwinds. For a lot of years it had some really strong headwinds. I made mention of the resources companies. So we've got positions in South 32 that we've added to in the last month or so. I think that's a business that can do very well next year. The large cap resource companies, BHP for instance, we've got that in the portfolio, and then the mining services companies. I think these are more volatile areas of the market. So if you look back and have they handled COVID? Have they been defensive, etc.? Probably not. But if I think about the companies that I want to be in going forward, and that's what, as investors, we've got to do. We've got to make decisions today on our outlook for tomorrow. So, mining services are an area that we like. Monadelphous we've got in the portfolio, NRW Holdings, and I think in the infrastructure space that's going to be a growth area going into next year as well. So we've got Lendlease in the portfolio. We're looking at Downer EDI to add to the portfolio here. So if I think internationally, I'm going back more towards those the value orientated areas of the market. So UBS is a stock that we've got in our international portfolio. Wells Fargo in the banking space is a really undervalued global bank in our view, but also tying that in with some interesting tech orientated businesses that I think have that have benefited from COVID in a structural sense rather than just a short-term earnings sense. So I like the look of Shopify. Trade Desk is one of our largest positions in the international portfolio. So we've got blended portfolios that have Aussie equities, international equities, and some other income type securities. But I'm reasonably excited going into 2021.